Imagine the scene. The year is 2008. The world is in the grip of a financial crisis. Banks are failing, businesses are shuttering, and economies are stalling. In response to this dire situation, central banks around the world, such as the Federal Reserve in the United States, unleash a powerful tool in their arsenal: expansionary monetary policy. But what exactly is expansionary monetary policy? It's a type of monetary policy that central banks implement to stimulate economic growth. This is achieved by increasing the money supply in the economy, decreasing interest rates, and buying government securities. Consider it like a shot of adrenaline, kick-starting the economic heart of a nation. When central banks lower interest rates, it becomes cheaper for individuals and businesses to borrow money. This encourages consumption spending and investment, which in turn stimulates economic growth. In addition, central banks can purchase government securities, such as bonds, in a process known as open market operations. These operations inject more money into the economy, reducing interest rates further and encouraging more spending and investment. The intended effects of expansionary monetary policy are manifold. By boosting consumption and investment, this policy aims to reduce unemployment, which often rises during periods of economic downturn. More spending means more demand for goods and services, which in turn means more jobs to meet this demand, as labor is a derived demand. However, it's not all sunshine and rainbows. Expansionary monetary policy can also lead to inflation. As the money supply increases, prices can rise as well. If not managed carefully, this can result in inflation overshooting its target, a situation that can be just as detrimental as the economic slump the policy aimed to combat. So, to recap, expansionary monetary policy is a tool used by central banks to stimulate economic growth. It works by lowering interest rates, purchasing government securities, and increasing the money supply. Its intended effects are to boost consumption and investment, reduce unemployment, and potentially lead to inflation. However, it must be managed carefully to prevent inflation from overshooting its target. Remember, like any tool, it's not about whether it's inherently good or bad, but how it's used. It's an essential part of the economic toolkit for addressing downturns and stimulating growth, but it must always be handled with care, precision, and a keen understanding of its potential effects and consequences.